Hey, welcome back to Everything Money. We are glad you joined us again. Today, we are talking about the Goliath that is Microsoft, an incredible company. We will go over the financials and the fundamentals behind this company and show you how that translates into an appropriate stock price. You will use our software. We will show you how to use our software to go through these financials, and potentially you can gain control of your investments, fire your financial planner, and really grow your wealth your own way. If you're looking to trade Microsoft, we will head over to the handsome Mo, and he will show you those confusing charts, which aren't that confusing if you want to trade Microsoft on a daily, weekly, monthly basis. But first, who are we? Paul, people were hesitant to hear about who you guys are, but I have to say that I'm you. I'm the viewer sitting at home watching this video, and I ask a couple wealthy guys that manage over $100 million in real estate, stocks, assets. They're bonkers. I see them on an everyday basis. I'm learning, and you can too. We will show you all the ins and outs about Microsoft right now. And I introduce you to the seer of seers, Paul Gabriel.
Hello, everyone. First off, follow us on Instagram. We have a new Instagram account, and also follow us personally because it makes our moms very proud.
That's true.
All right, so we're going to look at Microsoft today. Big high flyer,
yes.
Company that I have a lot of history with. This is our exclusive Everything Money software. So we're going to go look up Microsoft. We click the 8 Pillars tab. I'm going to make the screen just a smidge bigger.
If you've ever wanted to find this data and found it confusing, going on Google, going on Yahoo, you can come to Everything Money and have all the data right in front of you right now. And we'll show you how.
All right, guys. So let's get started. Microsoft market cap, $2.5 trillion. It just surpassed Apple the other day for the biggest market cap company out there, which is funny because 10 years ago,
yes,
I was told how dead Microsoft was. I was made fun of by a tech executive in Cleveland telling me I didn't understand tech. Microsoft is dead and it is going to zero. So our first pillar, guys, we look at our 8 pillars. Our first pillar, we want the 5-year PE to be under 22.5. It's 61.9. That's an X. Okay. Pillar number 2. We want the 5-year return on invested capital being greater than 9%. It is 17.5. So that's a check
pretty
mark.
good, yeah.
What this means is they're good at investing their capital within the business. Capital within the business is made up of 2 things: debt and equity. They get a great return on both of those. Okay. Dividend yield. Now, guys, the dividend yield, because of such a high market cap, is very low, 0.7, almost half the market. But that eats up $16.9 billion of their cash flow. So remember, guys, if you're new to the channel, dividends are not always secure. You have to look at the dividends paid versus the free cash flow generated. Luckily, because of our exclusive software, we put it right here on the main page for you. 2 lines up. The 5-year average free cash flow is $42.5 billion. Last year's free cash flow is $60 billion. They can easily cover that dividend with that cash flow. So I'm not worried about Microsoft's cash flow at all. So far, out of 2 pillars, we have 1 X on the 5-year PE and 1 check mark on the 5-year return on invested capital.
So pillar number 3 is profit growth, revenue growth over the past 5 years. Paul, I always get these confused. Pillar number 3, give it to me.
A lot of people confuse that. So I go to our software, I click on the income statement, guys. Then I just scroll down here. I go 5 years ago, 99.18 billion. Last year, 176. Now, Seth, here's the interesting thing. 5 years ago, I would have looked at this growth and said, and this ain't a big growth here, I would have said not sustainable. And they almost doubled.
Yeah.
So this is the hard part about investing. We don't know the future, and it's all based on assumptions. This is a massive check, but it just goes to show how we don't know the future. By the way, dead company. In 2011, I was told that it was dead. And they did revenue in 2011 of 71 billion, and now they're at 176 billion. So that guy's smart.
Profit growth is pillar number 4. How's their profit doing?
I just scroll on a little bit further, 26.4 billion to 67.9.
Tripled.
So another check mark there, massive check mark. Now, Seth, pillar number 5 is one of the most important ones.
Mm-hmm.
Shares outstanding. Nobody really understands how this is the silent killer in investing. With stocks, if the company is issuing more and more shares, they are diluting you as an owner. If they're buying back shares, they're increasing your ownership of the company. Now, with a company as expensive as Microsoft, I don't want to see a ton of shares being bought because I look at it kind of going, listen, basically the company is investing within itself at a really high premium. We don't want that. So I'm hoping the share buyback isn't very large here, and I'm hoping it's actually steady. So I go to the very bottom of the income statement. Shares outstanding. Oh, good. 7.71 down to 7.51. It's still a check, but it's not some massive check. Do you know what I mean? They're not buying back, 40% of their shares or anything like that. Yeah. It's a very small amount. So I like seeing this. Okay. Now, pillar number 6.
Yeah, this involves their debt, Paul. Pillar, we want to look at, see, can they sustain potentially a correction in the market? So what kind of debt do they have?
Well, not correction in the market.
Go on.
We're worried about a recession. If a recession hits and their revenue is hit because remember, the stock can fall by 80%, the company still keeps going, right? So what we're more worried about is companies with lower debt will withstand recession a lot better. So what I do is I go back to the main page of our software. I look at our 5-year average free cash flow. I multiply that by 5. That comes out to $212 billion. So what I want here is I want their long-term liabilities to be under $212 billion. So how do I find that? I go up to the balance sheet. I scroll to the very bottom. Long-term liabilities, $103 billion. Massive check. So they can pay off all their long-term liabilities in a little under 2 years. 3 years of their average, 2.5 years of their average free cash flow. Last year they did $60 billion in free cash flow. So 1.6 years of free cash flow gone. They have no more debt. That's an incredible number. Okay. Our final 2 pillars, guys, and the most important ones. We want to see free cash flow growth over 5 years, and then we want to assign a multiple to that free cash flow to come up with a value for the company.
Yeah, I'd be interested to see here with this multiple because I have some questions for you.
And I've actually been lying to you. I forgot there's a 5th thing that you can do with free cash flow. So guys, free cash flow is cash from operations less your capital expenditures. Now, what we do in our exclusive software is I added this line to the free cash flow statement. I've not seen any other software add the line right here. It does the math for you. So 32.3 to 60.4, check mark there. What is free cash flow going to be used for? It's actually 5 things. Paying dividends, buying back shares, paying down debt, making acquisitions, and reinvesting in themselves.
How so?
Well, I mean, you sit there and like a company would build a factory. Or a Microsoft would.
That comes out of free cash?
Yeah, of course. Because if they're like sitting there saying, listen, we're going to go invest in this factory to get more growth, et cetera, that's what they're going to use the free cash flow.
So what's the difference between profit and free cash?
Well, profit is based on net income. Net income is based on SEC rules and accounting rules. So that can manipulate the number a lot easier than free cash flow. Because free cash flow is cash in, cash out. Now, does that mean free cash flow can't be manipulated? No.
I see.
But it's much harder to. So our final metric is we take the 5 years of average free cash flow, $42.5 billion, and multiply by 20. We are starting at 20. It's not set in stone. A faster growing company should get a higher number, but it's just a starting point. So $42.5 billion times 20, $850 billion market cap. It's currently you heard Mo just laugh, 2.5 trillion. Now, that's an X. Before you sit there and say this is off, their 5-year PE was 62.
Makes sense.
So to make it 1/3 that, it's still 20. Mm-hmm. So it's not like it's a ridiculous number, right?
Right.
Now, guys, for those of you who want the easy method, this is our software. Guess what? We do all the work for you. Look at this 8 pillars tab right here. Uncle Seth, is this not our favorite 8 pillars besides all of them?
It is. It just means we need to wait until it comes into the sweet spot, as Mo would say.
Correct. So the valuation metrics, the 2 value metrics, are the most expensive ones. And I love the fact they're very close to each other, 59 and 62. So guys, we created this software specifically because our users said, hey, instead of us waiting for you to make all these videos on companies we want, how do we do our own work? So we created the software. I invested hundreds of thousands of dollars continuously, the data, making the software. You get everything you've seen so far, plus all news, videos, and all of these things on the right side that are coming. You get exclusive daily content from us on the app. This all comes in app form, so you have it right in your phone. You get exclusive daily content from us, 2 or 3 videos a day. You get access to Seth, Mo, and I. You get the community. There's over 6,000 people you can talk to in our chat that you can talk to on a daily basis because most of our viewers have realized they don't have the access to people. They're in their own island at home, not talking to people about investments that make sense to them. This is a no-brainer, guys. It's only 90 cents per day. You can sign up on everythingmoney.com or patreon.com. Either one, you get the access within minutes. The benefit of going directly to everythingmoney.com is no sales tax for right now, and you don't get double charged in the first month, which Patreon does for you. Again, if you feel more comfortable with Patreon, go for it, but everythingmoney.com is cheaper. anyway, and you get direct access. So guys, 90 cents a day. If you're serious about your financial future, this is a no-brainer. 90 cents per day can make you hundreds of thousands, if not millions. Go there, sign up now.
While Paul pulls up the stock analyzer tool, we'll show you how to come up with a price to pay for Microsoft. Paul, this stock, if you look at the long-term trend, we started this show around 2018. You started talking about an overpriced market, and sure enough, that's when this company really skyrockets up. The PE goes up, and the price gets a little overpriced, in terms of its ticker price. But the last decade was pretty consistent growth out of a company. Now it's just completely exploded. So we really need to wait if we're looking to invest in terms of a value investment. We need to wait till this falls back down into the sweet spot. So
correct. Now, guys, this is the most exciting part of our software because it'll tell you based on your assumptions what to pay for the stock today or what you should be paying for the stock today. So in our stock analyzer tool, you first pick the number of years you can do. You can analyze up to 20 years. Then you pick the number of assumptions, 1, 2, or 3. For a company like Microsoft, more established and bigger, I do 2 assumptions. It gives you the 1, 5, and 10-year numbers on all the assumptions here. So on revenue growth, the bigger the company, the lower the revenue growth possibility. So I'm still going to go 5 and 8%. Share change, I'm going to go negative 0.5% and negative 1%.
So they're buying back -1.
They're buying back 1%. They're buying back 0.5%.
Yeah.
Profit margin, I'm going to go 27 and 32. Free cash flow margin, 31 and 33. Actually, I'm going to go 30 and 32. PE. Now, guys, this is a big company. I'm going to keep it tight. 14 and 16. Now, for my desired return.
But wouldn't someone say, Paul, that like the 5-year PE is 61? It can't you're saying it obviously can't maintain this. Companies like
Correct.
Tesla, when they get this enormous, they can't maintain a 70 PE.
Such a big company like this, the long-term average is 15, so I'm going to go right in between them. 14 and 16 for the average of 15. Now, for desired return, guys, you can go to an ETF and get 10% return just following the market, not doing any work. So for you to go buy individual stocks, I want a little bit of buffer there. I'm going to put 12.5% return. Very simple. I hit the analyze button. Boom. Guys, overpriced. It tells me my low range is around 100. My high range is 150. It's just overpriced.
The current price is 330.
So, and guess what? Makes sense. It's actually giving a bigger premium because the 5-year PE, if it went to 150, would be roughly 27. So I'm still giving a premium for a faster growing company. But it's just too expensive, guys.
So to translate this, so to translate, if you buy at 150, our projections say you'll make 12.5 over the next 10% over the next 10 years. But if you buy at 300, you very well might not make anything over the next 10 years. So
we can actually do it. We can actually go 3. Let's see if it's 3%. No, not even 2%. So there you go. Based on the high assumptions, you're basically getting a 2.5% return on your money by buying today if these high assumptions prove out. Guys, every investment is the present value of all future cash flow. Now, the good news is you can still go to Trader Mo and trade this company and not care at all about the fundamentals. So that's the benefit of Everything Money. We can talk about ways that don't involve fundamentals to make money. So Mo, how would you trade this?
Yeah, show us, Mo.
So this company is a beast. It just keeps going, and these are all-time highs. So what it's doing right now, and I'm going to pull this back in a second, I'm going to tell you what to do here. If you get an engulfing candlestick like that, making a new all-time high, you're fine going at it. But let's just zoom out here and let me show you how you would play this as far as taking profits. So often people say, when do I exit a stock? When do I take profits on a stock? It's very easy. When you have a stock like this and it gets into this overbought area, over 80%, as soon as that red line dips below yellow, that's when you take your profits off the table. Let it coast. As that red line is below yellow, the stock price is going to drop down, and then just play it as normal. Once the red line pops above, find some engulfing candlesticks like you had right in here, and ride them back up. So there's different ways to play this. Put the money in your pocket. It's better when you're doing these kind of trades, the goal is to make money in a much shorter term than 5-year period or something. So put the money in your pocket and learn how to take profits like this. And if you want to learn, come over to me in the Bid and Ask Nation and join you get access to the Trading 101 series, the Employed Trader series, and you get all of these teaching tools from me for $1.50 more per month. Per day, in addition to everything with the Everything Money software.
Final take on Microsoft, Paul.
I'm just waiting for a better price. I love the company. I love their cash flow. I love how they're doing great in fighting Amazon and the what's it called? The server, the AWS's competitor, the cloud-based computing. I'm just waiting.
Yeah, that's our take. That's a value investing approach to looking at Microsoft. Fondle thumbs up. Watch more of our videos. There are 1,000 of them.
Over 1,000.
And Mo goes live every morning for your trading news, notes, and sarcasm. Thanks for watching. Fondle thumbs up. See you next video.